Hello, everybody. Thank you very much for joining us. I'm Sean Brown. I'm the head coach at YCharts. I'm super excited to be joined by my friend, close to my favorite Brown, next to my direct family members, maybe James Brown, Jim Brown, the running back, bad Leroy Brown, potentially Charlie Brown. Josh, anybody I'm missing? But otherwise, outside of that,
are we related, Dad?
You're way too good looking to be in any way related to me.
Yeah, my family's actual last name was Braun, and it was changed at Ellis Island. So a little bit of trivia that I learned.
Well, let me refine things. And you are my favorite former Braun.
Right. Well, Braun means brown in German, so yeah. It's the same thing.
Yeah, and Sean means John. So we're welcome here, Josh. First of all, thanks for joining us. Thanks for your friendship. Thanks for your partnership. Thrilled to have you on the show.
This is the pleasure is all mine, as you'll soon see.
Hey, we're also joined by Caleb Epplett, who is my colleague, my therapist, and the chief product officer at YCharts. Caleb, welcome to the show.
Thank you. I'm happy to resign that second role if anybody's in the market. So
yeah. Hey, we're here to discuss the charts that define 2021. That's kind of the undercard. The main event is going to be objectively determining whether the best pizza is produced in Chicago or New York. So we'll have some charts interspersed in there, but I think let's just be clear on our priorities here. Caleb and Josh are going to put aside their biases, and we are going to figure out this whole pizza thing. But before we get going too far, let me go over a couple logistical things. First of all, if you have any questions on the webinar, please don't hesitate to submit them in the Q&A button at the bottom. Please keep in mind that the content of this webinar is meant for educational purposes only. Neither Josh, Caleb, nor I are intending to give investment advice, and we are not acting as an advising party with regards to client funds in any way, shape, or form. On a better note, all charts in this webinar are going to be available for anyone who has a license to YCharts in the fundamental charting tool under templates. And if you don't happen to have a license to YCharts, these charts are also available to you if you sign up for a free trial at YCharts.com. And then finally, this recording is going to be available to everybody through our YouTube channel, and a copy will be emailed to all attendees. So let's get started right now with the pizza smackdown. Josh, why don't you educate our attendees on how you and I came to tee up a pizza smackdown?
Well, I think I had said something mildly disrespectful about Chicago-style deep dish pizza. And by the way, I love Chicago, and I've eaten many, many amazing Italian meals. And I am aware that deep dish is only one type of Chicago-style pizza. But we don't have to go into exactly what I said, and I am willing to have my mind changed. But I would submit before we do any kind of tasting that New York has better pizza than probably anywhere on earth, maybe even including Italy. And I stand by that statement. Although today I might be forced to rethink that.
Yeah. Well, I mean, we're going to figure this out. We're going to figure this out in an objective manner. And the way we're going to do this is Josh and Caleb, and I'm on the side just with my own pizzas, but I don't count.
Totally objective.
I can't be objective here. And Caleb works for me though, but I do encourage him to be as objective as he can be, knowing that this is important to me, Caleb.
Okay.
But we have two winning pizzas that Josh and Caleb are going to be trying. One is from New York City, Prince Street Pizza. So we're going to be tasting the spicy spring pizza, which whoa, wow, look at that. That is just chock full of pepperoni. It's Fra Diavola sauce, spicy pepperoni, and fresh mozzarella. That's number one.
What we say in New York is forget about it.
Forget about it.
Prince Street Pizza, forget it.
Forget it. And representing Chicago is Lou
Mm.
Malnati's deep
Hold it
dish
up.
sausage pizza.
Wow. Is your wrist hurt? That looks heavy. That looks substantial.
With
All right.
with a half-inch thick wedge of
Look,
sausage that runs
I'm
throughout the pizza.
I'm into.
So guys, here's what I would like to do. I want to have you guys taste the pizzas, and we're going to start with the Prince Street pizza. Want to have you taste the pizza. Would love to hear your voiceover on what you're tasting. But then you're going to, behind the scenes, in a secret sheet, you are going to put your scores 1 through 5, rating these pizza slices in the categories that I got up on the screen: appearance, cheese, sauce, and crust. We're going to take your scores, average them together, and we're going to find out objectively who has the best pizza. So let's start.
I'm going to go on mute while I chew, so nobody leaves. Is that cool? Just for a second.
That sounds great. Why don't we start with the Prince Street pizza?
I'm also, by the way, you would never catch me dead doing this in New York on the street. I'm going to go knife and fork for this, just because I have to use the mouse, and we're going to get serious in a minute. So don't tell anybody that you saw me eat New York pizza with a fork.
Yeah, no, and we, despite what you may, although this recording is going to be available to all, I'm sure we will try to edit out the part where you put a knife. And if you wanted to scrub, Josh, feel free. So Caleb, I'm going to start with you, even though you're only half finished chewing. First of all, generally speaking, what do you think of the New York City pizza from Prince Street?
Yeah, so my initial reaction to this pizza was it wasn't what I expected when I knew we were going to have a New York versus Chicago pizza showdown. I was really excited to highlight the fact that the Chicago pizza is going to have a little toppings in every bite, and I didn't think that was going to be the case in New York. I'm pleasantly surprised with the sheer amount of pepperoni here. Great taste, nice little spice to it. Overall, really, really pleasant experience.
Josh, what are your thoughts?
I'm off mute, right? You guys
Yep.
got me? All right. So the thing with this slice is, when you first see it, like visually, you say, oh my God, that is a ton of topping. That is a lot of pepperoni. But when you taste it, it's not quite as overwhelming as you might initially expect. So I think it looks gorgeous. Obviously, this is for meat eaters, right? But on the appearance side, I really have to give the edge to the Prince Street slice. That's not the only thing we're scoring here, because I like the appearance of both, but I have to be honest, just solely curb appeal, I got to go Prince Street.
Okay. All right, guys.
Fair?
Yeah, that's, well, anything's fair, Josh. You get exactly one vote in this thing. So whatever your thoughts are, but let's dive into the second slice, which just looks and sounds amazing. I will tell you
also beautiful.
The Malnati family is from the town I live in now. They will be watching this. They will potentially be sponsoring any podcasts from any New York City-based reform brokers, depending on the outcome. But Josh, let's get some unbiased. Caleb, why don't we start with you again, if you've had a chance to take a bite, and you haven't. Did you do something to cleanse your palate? Did you have some ice cream or something just to make sure? Oh, a beer or some other. All right.
Okay, that's delicious. So basically, on top of the crust is a layer of cheese, and then a layer of sausage, and then the tomato on top. And it looks like there's some Parmesan on top of the tomato. That's really good. That's fantastic. And it traveled really well.
It's nice to hear. Caleb?
Yeah.
I have to agree. The sausage is definitely the star here. You're not going to go hungry eating this pizza. It's a city for broad shoulders. Also, we fill those shoulders up with pizza, and sausage from side to side. So, not quite as much spice as the New York pizza, but really nice kind of herbs coming through here too. So,
okay,
very, very good.
Well, listen, I guess we're getting an early preview. You guys, I'm going to ask you, while I tee up the fact that we're going to move on to charting, if you guys can kind of behind the scenes place your objectively placed, not manipulated votes, and we'll look forward to seeing that at the end of this this webinar.
One more thing on the pizza, I would say Chicago has the edge on the sauce for sure. That is a delicious tomato sauce. So in my early evaluation, I'm going to give a 5 to that sauce. So congratulations, Chicago.
And you believe that your 2 slices have a sufficient amount of crust, Josh, that you're in a good position to objectively assess crust for both pizzas, correct?
I am.
Caleb, do you have any concerns before you place your votes, or any final comments?
I don't. I think the crust was the hardest to compare side to side because they're so different, but
yes,
I feel good about my scores.
Okay. Well, guys, thank you. For the gravity of this is heavy, and I know it's weighing on you. So get those scores in, and let's move on to the under.
Okay, let's do it. Let's do it.
All right, guys. So here's what I want to do while the crack team tabulates the votes over the next lengthy period of time. I want to go over some charts. What we hope to do is we have 14 charts submitted by industry luminaries and real experts in the space that fall into 4 categories: macroeconomic data, the markets, and trends. And actually they fall into 3 categories, and then we're going to do the pizza smackdown. Again, these charts are all available to you in your account, your logo, do what you want with them, share them with your friends, put them in your annual report, whatever you'd like to do with them. But let's get into the first category of charts, which is macroeconomic data. So our first submission was by Charlie Bilella, who I really like. He's the CEO of Compound Advisors, and Charlie is a very analytical person. And Charlie put together this chart, which really talks about real interest rates, which I know everybody listening understands. It's kind of the implied rate considering inflation. And he points out that it's at a low for most anybody on this webinar's lifetime. So guys, what are your thoughts on interest rates and what happened here and where they're going? And I'd love to spend no more than 2 minutes per slide because we have 14 to go through.
I'll jump in. I would just say that for the last 75 years, bonds served 2 roles in a portfolio. The first was current income, and the second was stability relative to equities. And today they only serve 1. And that is something that Michael Batnick has been talking to our clients about for years now. And of course, that got really pronounced a year ago when it became I think very, very possible to see nominal yields of 0 or below. And we saw oil, a barrel of oil cost negative numbers. Why couldn't, a treasury? So we didn't quite get there. Doesn't mean we never will. I don't think that that's one of the big risks of 21, but of course I never could have foreseen the big risks of 20 if we were having this conversation in December of 19. So anything can happen, but one comment I would make is bonds did do their job in terms of offsetting volatility over the last 2 years, despite the fact that we had a yield curve inversion in late 19, despite the fact that nominal and real yields were extremely low to negative. They did act as the risk-off component of portfolios. They did enable investors to reallocate into big stock market drawdown. That dry powder was there. And so if you can accept the fact that they're only going to play that singular role in your portfolio, at least over the near to intermediate term, I still think bonds are an important part of the mix. However, I also think an important part of the mix is to remind clients that they're going to have to save more. There's a limit to what financial assets can do given high valuations for stocks, record low yields for bonds. So saving more is going to have to be part of the answer, probably a more important part of the answer than going out there and trying to find the perfect alternative. So I think we're very upfront with our clients about that idea. I think they appreciate that honesty, but we are not throwing bonds away. And the last thing I would say is, if you're a bond investor and you're worried about yields rising, prices falling, I would say you have it the other way around. You should worry about more of this. The thing that you want is for yields to rise, even if that means short-term pain in some portions of your bond portfolio. You're never going to make any money on bonds if yields don't rise, if the curve doesn't steepen, et cetera. So we're perfectly fine with rising rates. We understand what that might do to the stock market side of the portfolio, but our expectation is that this is not a permanent condition, and that there will be at some point money to be made in fixed income.
I couldn't agree more, Josh, with where bonds fit into a portfolio. The evidence maybe I would, add to your argument there, just as far as not looking to bonds for that income generation, right? You don't have to look back very far to see when the Fed's target rate was up around 2.5%, right? We were talking about the same thing with bond yields. They're super low. Bond yields have basically just been on a slow trickle down since that, prior big move down here in a negative real interest rate back in 1980. I don't think, the Fed's going to act and bond yields are going to start to creep back up, but they've got a lot of room that they can kind of move to get this real interest rate back up there in the zero range without having any type of bond yield that's going to get somebody excited on the income side.
Yeah, I hate quoting yields, changes in yields in percentage terms. I hate doing that percent on percent, but it is important to point out the yield on a 10-year has tripled since the start of the pandemic. So, it's not as though the bond market is not reacting at all to economic data. It's really the short end of the curve that on purpose has been suppressed, and that won't go on forever.
Thanks, guys. And Josh, I noticed a slight bit of indigestion. I'm wondering, which pizza would you attribute that to?
No, you didn't.
No,
you didn't.
Okay. All right then.
I could eat both pies in a single sitting. I have not yet begun to fight.
Yeah. Well, you guys, if either of you runs into any type of intestinal distress, please do just raise your hand. I know our audience would be happy to commiserate with you. But until then, let's head forward here with so Josh, on your team, Blair Duquesne, with a chart here, a creative way of depicting the fact that supply and demand are out of whack in the housing market.
Yeah.
She did it through a ratio, but guys, what's behind this, and what does this tell us about the future?
Caleb, why don't you go first on this one?
Yeah, let me unpack this a little bit, and then I'll turn it over to you, Josh, to talk about what's actually happening. But it's a perfect storm, right? We've got mortgage rates at all-time lows. We've got huge surge in demand for houses due to a pandemic. We've got a supply chain that was suffering. Building supplies were hard to find, right? So, just the overall supply for new construction was tightened. All of these different factors, this really was the only outcome that could happen. Now, whether or not this is going to continue, I think things will slowly start to return to normal. Like, we're already seeing the supply chain start to return a bit to normal. There's some seasonality for sure, but we're seeing, some of the new house purchase prices or new houses purchased month over month start to stable out. So I think that this trend is something that will come back to normal, but I'm curious what you think, Josh.
So it's interesting. We had a stock shortage. I don't know if you heard about this. For most of the last 5 years, there literally were not enough stocks to go around. And as a result, multiples, obviously in line with Fed stimulus and low rates, et cetera, but multiples for the stocks that did exist went higher. And not only that, multiples for stocks in the private market are higher than ever. And that is a function of there just not being enough things for people to invest in. The stock shortage got cured in the last year or so. We had this explosion in IPOs that started in the second half of 20. In 2021, we had $300 billion worth of IPOs hit the market. About half of that is in SPACs, which you can judge that how you will. But we had just some massive IPOs. The biggest one being one of the most recent, Rivian, came public. Robinhood came public. So we have slowly but surely cured this shortage of stocks. And now, for the first time in a long time, there are more than 5,000 publicly traded companies on the U.S. exchanges. So there used to be an index called the Wilshire 5000, which was meant to capture the 5,000 stocks that are publicly traded. We had 3,800 at one point a few years ago, and there was just no IPO issuance, and companies were staying private longer, et cetera. And I bring that up because it's an example of Wall Street stepping up and saying, okay, the ducks are quacking, let's drown them in new supply. If they want it, we'll give it to them. The housing market doesn't work that way. Toll Brothers and KB Homes and Pulte and Lennar, they've got land banks. They've got massive reserves of land that they have secured that they can build on, but they're not just going to throw up 1,000 houses a month because the market is crying out for it. In fact, if they had done that in 2021, nothing could have been worse for them because the margins on building new houses would have been horrific. So I do believe that take the demographic tailwind that everyone could have foreseen. We have record number of people that are age 29 and 30 and 31 right now. And these are peak household formation years. That's not going to stop, right? Low rates probably with us for a long time. I can't really imagine a scenario where they're not, which we just talked about. So low mortgage rates, affordable mortgage rates. And then just this idea of portability of a workforce and people not having to live 5 miles from their office to have a good commute. They can commute from the bedroom to the basement. So those three factors, I think, will keep housing in high demand. It probably won't rival what we saw over the last 18 months, of course, in terms of its pace. But the builders are not going to ride to the rescue the way the IPO factories on Wall Street have. So I would expect home prices to remain somewhat elevated. By the way, one other factor that we're not going to spend a lot of time on is incomes rising, and not just for the top 1 or the top 10%, but we are seeing a generational lift in incomes for people in the bottom 20%, the bottom 50% of the distribution. And not all of them, of course, will be able to buy homes, right? We're still talking about a lot of people on minimum wage, but that has the effect of pushing everything up rather than home prices just exploding at the high end and pushing everything down. This is a groundswell. And so I think it has legs. I think it's demographic. I think it's generational. And I think it's great for the economy. This generation that nobody thought would ever buy a house, turns out that was not true.
Yeah, it's interesting you brought up the point about wages rising. Caleb Silver, who's the editor-in-chief of Investopedia, submitted the next chart. And the blue line depicts just that. In 2021, the salaries and wages went up almost 10%. So also depicted on this slide, though, is there's a significant imbalance or disconnect between jobs and those looking for jobs. You can see 10.4 million people, 10.4 million job openings, and roughly speaking, half of that as far as job seekers. So it's a nice employee market right now. Guys, what are your thoughts on this picture?
Go ahead, Josh.
I think the Great Resignation is total bullshit. People are starting businesses at the fastest pace that we've ever seen in our lifetimes. There was an explosion in business formation, and there was an explosion in people registering new companies. And I think when you wonder why are there 10 million open jobs, where are all the people that would normally take them? I don't believe the talking points that government subsistence is keeping people from applying for jobs. I think it's the opposite. I think we're in this period where people had an opportunity to experiment for the first time and to picture a life for themselves where they don't have to go do this thing that they hate, and they don't have to do it 8 hours a day, 5 days a week. And this is not just like, what am I going to do while I wait for the pandemic to wear off? There are people who have created a record number of entrepreneurial sole proprietorships, and some of those will go on to become small businesses and hire other people. Some of them won't. But I do think that people just got this moment where they said, what do I have to lose? I got money coming in from the government or whatever, or I got no expectation that I have to be somewhere. And so I think that while we can look at this as a negative, obviously there's wage pressure, et cetera. I choose to look at this as a positive. And I think 5 years from now, 10 years from now, we'll really have a sense of how many people went out on their own and did something that they really always wanted to try. And I think it'll be a silver lining from the crisis.
I'll just add a couple numbers. I think you're right on. The number of job openings there, right? If you actually build this chart out today in YCharts, you'll see that's just over 11 million. Pre-pandemic, that number was about 7 million. So we've got 4 million more jobs available than we did pre-pandemic. Now, if you look at this great resignation, you look at the number of quits, it's not that much different on a monthly basis than it was pre-pandemic. Sure, it's a little bit higher. And we've got a decrease in job seekers because so many new people have gotten jobs, right? But there's clearly new roles that are opening up. There initially there were a lot of roles that needed to be refilled after, businesses were closed down for a while in the pandemic. I think we're past that. Now we've got people looking for specialized hires. We've got a ton of job openings that are, new jobs being created based on the data.
Well, we really can't talk about the macroeconomic climate of either 2020 or 2021 without a couple charts and some commentary on the impact of COVID. And Sam Russell, who's the chief evangelist for FMG, a sobering statistic here, which is the total number of deaths, which really isn't talked about too much anymore. And then the vaccination rate, which is at once encouraging and also discouraging that that's not moving as quickly as some would like or some other countries are setting. But I think the real point isn't either of these two statistics. It's the impact of COVID on all kinds of factors, societal, economy, et cetera. Guys, what's your commentary on COVID and any commentary on going forward? Are we over COVID or what's the forecast?
So I would have done this chart differently. I would have done the cumulative number of people vaccinated in the top pane. That would make more sense if you're showing the cumulative number of deaths, which I think is what we're showing in the bottom pane. So I think that would have been a little bit more illustrative. And I think what we would have seen is that cumulative vaccination total starting to go vertical, obviously January 21. And then this other number of deaths tailing off. But I think Samantha brings up, obviously two important stats here though. And the supply chain thing is interesting. I read all the same inflation data as everybody else. I think we probably have seen the peak of supply chain related disruption. And I listened to hour-long interviews with the chief commodity strategist at Goldman Sachs, Jeff Curry, and people that do this for a living and really talk to Fortune 500 industrial companies and really get information. And there will be some lingering effects in some markets, and in other markets we'll get a full correction back to normal trend. Wage growth probably doesn't continue to accelerate. However, the gains in wages probably stay very sticky. That's like entirely in keeping with history. So I'm not one of these people that's panicking about microchip shortages and Ford F-150 shortages. It strikes me that all of these things are going to be brought back into balance. There's nothing magical needed. It's just people going back to work, and that's already been underway. So I'm not a chicken little over inflation. Last thing I would say on this, as it pertains to wage growth, a lot of what we're living through is just a catch up. We spent 25 years with flat wages for a large segment of the economy. And the wealthiest part of the economy made most of their money, not even through wage increases, but actually through stock market and real estate wealth, right? So seeing that big jump, it's a little bit scary. The numbers are almost cartoonish. It's not going to continue at that pace, number one. And number two, if you look at a 30-year chart, it actually makes a lot of sense. And COVID was just like the straw that broke the camel's back for that to all of a sudden happen all at once. And I think that's a more constructive way of thinking about the after effects of the pandemic.
And just to answer your first question there, Josh, I was able to pull that up quickly. It's just under 200 million US people that are fully vaccinated right now. The other thing that I like to think about when I look at this is kind of the short-term reaction versus the longer lingering term reaction. And you talked about this a little bit, Josh, and the inflation and the wages. But when this pandemic first hit, there were some very knee-jerk reactions. We saw huge swings in the stock market. We saw shortages of goods. We saw unemployment insurance claims hit numbers that were just absolutely insane, right? Things had to be done quickly to counteract those moves. And that's where the longer lingering effects have come from, right? Which is the inflation, which is the wage growth, the government spending, money supply, right? It's going to take longer to see these kind of lingering effects unwind and change, and they're going to have a longer term effect. But it's kind of the same thing on the social side, which Samantha mentioned here a little bit, right? Initially, there were a lot of very kind of severe conflicts, right? Problems with hospitals being completely overrun, right? Very, very, bad and scary things kind of happening, in the world. And now, we're getting away from those very acute instances, but we've got this lingering kind of effect of like the division around whether or not, vaccination is the right way to go. And again, these kind of lingering effects, they're going to take a lot longer to heal. But I'm excited to see us kind of moving on.
Yeah. So I don't listen to this Fauci guy. I think his moment is past, and he's somewhat of an alarmist. He almost goes out of his way to put his credibility in jeopardy with every appearance he makes. So I've been listening to some of the other people from the FDA who I think are much better spoken on this topic. And what it seems like, and of course, I'm not an epidemiologist, but it seems as though the pandemic is now over. And now we're going to have epidemics. And so we have an Omicron epidemic in certain areas of the world, not the entire world, at least not yet, and hopefully not ever. It seems as though antivirals will come along in 2022 and people will take them prophylactically. They'll say, I'm going on a ski trip in the Alps for 7 days. I'm going to bring my antivirals with me just in case. So that's the world that I hope we're heading into next year. Of course, things can change, a new variant come out of nowhere, throw a monkey wrench into that. But between the convalescent who have had the disease and the vaccine coverage, which is spreading all over the world, and just this idea that we're now better at treating this. It's not, nobody thinks this is a death sentence. Of course, it still could be, but that is not the way people are behaving and carrying themselves. We're not wiping down groceries. We're not afraid to attend a ball game or a concert. So from that standpoint, I don't think we're going to be using that pandemic word anymore to describe the present situation as we go into 22. This is just now endemic to the human population. We'll learn to live with it. And so to get back to the question of supply chains, et cetera, there's no reason why that stuff should normalize. When I saw that spike in lumber prices this past spring, which of course coincided with the building season, nothing about that looked sustainable to me. In fact, I'm not on Twitter, but if I were, I would have tweeted, guys, lumber, seriously? This shit grows on trees, right? So literally grows on trees. So that's where I am mentally with all of this. And of course, we still have to be vigilant and we want more people to get vaccinated, et cetera. All the things I'm supposed to say at the end of that. But I don't think that we're walking around saying pandemic every 5 seconds next year. I know I won't be.
Guys, that's awesome. Awesome commentary. And we got 10 more charts to go through, but we went through the macroeconomic one. Let's jump into the markets.
Look at that guy.
Look at this guy, your co-host on What Are Your Thoughts? Your team member, just somebody we adore. Guys, I won't give much of a voiceover to this. Interested in you guys talking to all of us. What is Michael depicting in this chart?
Caleb, go ahead.
Yeah, nobody's better at agreeing or disagreeing with Michael than you, Josh. But when I look at this chart, I look at these as two very different stories, right? It's a really interesting phenomena that happened when you look at Zoom's market cap eclipsing ExxonMobil. I think on the Zoom side, that's that knee-jerk reaction I was just talking about, right? Everybody went to work from home. Everybody went remote. Everybody needed a video conferencing software. Zoom obviously stepped up and everybody jumped on and bought the stock and the valuation got a little bit out of control. And you can see that started to normalize since. Zoom's not going anywhere. We're using it right now. It's going to continue to be used. But maybe it was
an enterprise license. Are we paying for this?
We do. We're on the up and up with Zoom. But you can get my Netflix pass for later if you need it.
All right. So at one point in 2020, Zoom had a larger market cap than ExxonMobil. That's actually incredible. For most of my life, ExxonMobil was one of the largest market caps, I think, in the world. It was in the Dow the entire time. So that's really is an amazing moment. And I think you could have done a lot of versions of this. You probably could have done this with like an airline and Peloton, or I think there's a lot of versions of this where You know, what we did in that moment, we, like the collective we, is we started pricing stocks as though the environment we were in would be permanent. And it's so easy to lose sight of in the moment when you have companies that are saying, oh, our user growth last quarter was 900%. And then you see the price of oil go to zero, literally negative $20. It's really easy to lose sight of, hey, this is today. This is not always. And so I suspect that mistake was made here. But it looks like it was corrected fairly quickly.
All right. Lynn Alden, who is just a terrific analyst and terrifically smart individual, she did this ratio chart, which tells a story about energy and the prominence or unprominence of energy. Guys, what are your thoughts on energy in 2021 and looking forward?
Well, so I have a view that oil consumption is in secular decline forever. There'll be cyclical, ups and downs, but you listen to the guy from what is it called? Stellantis? What are they calling Chrysler these days? Is that what it's called? All right. They don't have any electric vehicles. The guy went on TV yesterday and said by 2025, every single vehicle they make will be electric. So let's take him at his word. And let's just say that's a microcosm for what you're going to see out of Benz and BMW and Volkswagen and Ford and GM. So I don't feel like I want to make an energy bet versus the broader market, even though this chart is very compelling and it does look to a bottom, that ratio. It's very possible that energy can go back to 8% of the S&P. In the mid 2000s, I think it was as high as 20%. I just wouldn't bet that way. And so I would be surprised if 10 years from now, that energy index is still dominated by oil companies. I don't think it will be. I think there'll be solar stocks in there and transmission companies and battery companies that hopefully the Standard & Poor's Index Committee will reclassify and make the energy index truly representative of what the energy mix will be when we arrive at that time. So look, these have been great trades. The XLE, or I think the energy sector all cap, is up 50% year to date in 21. And not a lot of people were betting that way at the end of 20. So if you made that bet, you crushed it. You doubled the performance of the market and then some if you were overweight energy. It's not something that I, as a longer term investor, am particularly interested to do.
And Josh, what you mentioned about hopefully some other types of companies finding their way into those energy indices, I think that makes a ton of sense. It does kind of affect the point I was going to make, right? Which is the correlation between the S&P 500 and the energy sector is just completely eroded over the last 5 to 10 years, right? You go back to the 1900s, early 2000s, that correlation was pretty strong. Since 2014, 2015, there just is no correlation there. And part of that is because the energy sector is such a small percentage of the S&P 500, right? I think it's like less than 3% of the index at this point is invested in the companies that make up, that all cap.
It got down to 1. It got down to 1%.
Down to 1. So
yeah, amazing.
I mean, even more of a strong case, right? So I think Lynn makes a strong point here. But as far as an investor, thinking about oil prices, thinking about energy, if you're not specifically going out and making that investment, it's just not impacting your portfolio the way it used to.
Yeah, right. So we have these dramatic moves in oil, and they definitely affect corporate earnings outside of the energy sector, but the stocks themselves have no impact on what the S&P 500. Apple is almost a $3 trillion market cap right now. So as big as Exxon is, there's really only one of those. And then the next tier down is somewhat smaller. And then you got all tiny companies at this point. One thing to caution people about, this idea about cyclicals and the cycle and that it's big swings, for some commodities, the cycle ends permanently. And coal is a really great example of that. When I started in this business in the late 1990s, everybody was involved in technology stocks. And then in 2000, those blew up. And what replaced technology stocks as the hot thing to trade was resources companies. And I could reel off a litany of publicly traded coal companies that were red hot trades. Things like James River Coal, and International Coal, and none of these exist, by the way. There aren't. I think there might be one public coal company, or I could be wrong. All of them, all went bankrupt. So it's not true that every commodity gets to have a cycle and a comeback. And the same thing I just said about coal, I could also say about steel. We had U.S. Steel was one of the largest companies in the world. It's a shadow of its former self, and that's the only one left. Bethlehem Steel is gone. I could give you 50 other examples. When I started in this industry, steel companies were important. Wall Street was tracking the price of steel, the way those stocks did, the conference call. Nobody cares at all anymore. So a lot of commodities end up fading permanently from the stock market. And I'm not suggesting that's what we're going to see with oil stocks. I'm just letting people know, A, it's possible, and B, it's happened within our lifetime already to some pretty notable segments of the energy patch.
Thanks, guys. Hey, Caleb, so YCharts just rolled out some new scatter plot functionality. So we scatter charts. We had to fit one in here. What's the key point that Jeff Kilberg, who's the Chief Investment Officer at Sanctuary Wealth,
AKA Killer,
former Notre Dame football player. What key point is he looking to make here?
So I think Killer's point here is just, value compared to growth and the outliers here. The thing that jumped out at me when I looked at this chart, I was looking at some of the call outs. I saw Walt Disney down there as a growth stock. I said, when did Disney become a growth stock? So I went and looked, and in Vanguard's growth portfolio, there it is. If you look at iShares' growth portfolio versus their value portfolio, Disney's in the value portfolio, right? So their PE ratio has gone through the roof since their earnings disappeared kind of early in the 2020 time period. But the thing that jumped out to me there is know what's in the funds you're holding, right? Because it makes a big difference. You can see these outliers, but that doesn't change the point that we've seen growth continue to outpace value. Another interesting thing, right? The volatility associated with value over the last 10 years is actually greater than growth, right? So you're not even necessarily getting that stability that you think. But over the course of the short term, if we're in a bull market, I think the growth bubbles are going to continue to show up here and lift the overall portfolio.
A lot of what we're talking about here really is not value versus growth beneath the surface. It's industry versus industry. And so when we say value, we're not saying cheap stocks in every sector. What we're really saying is value is financials, it's energy, it's industrials, it's materials, and it's utilities. That's what value stocks are. And then when we say growth, we're saying consumer discretionary, healthcare, tech, communications. Those are the growth stocks. And a lot of what goes on, it's not people making conscious decisions and saying, I'm bullish on value stocks today. That actually is not a thing that goes on at any asset management firm anywhere in Boston, on Wall Street. The conversation is, what sectors do I want to overweight? Or what companies have the characteristics I'm looking for these days, quality and growth. And it just so happens that those companies tend to be in the last few industries that I mentioned and not in the first few. So, and the way that's true is you look at portfolios being managed by people who don't use those loaded terms, value or growth, or look at international markets. It's very much the same thing, So I think we have to get past this idea that investing in growth companies means you don't care about the valuation, or investing in value means you don't care about innovation. It's not true. It's a false choice.
That's awesome. So Beth Kindig, the lead analyst at IO Group, put together this chart on the FANG MGs, and I guess the F's not even an F anymore now that it's Meta. But what are you guys' thoughts
about that? So what is it? What is the acronym now? Is it?
I don't know.
I was thinking the same thing. It's Manma, which doesn't have a great ring to it.
Well, also, I don't agree that Netflix belongs there. Nvidia is a $700 billion company. I don't agree that we should be hanging on to Netflix there either. So switch that end for the other end.
What's the story with big tech going forward?
I guess just quickly, the thing that I think is interesting, right, is these stocks get so much publicity, right? Obviously, they're massive, right? If you add the market caps up between these companies, it's about $10 trillion, which is about half of US GDP, right? It's just absolutely massive. Now, all of the attention that these stocks get, I think everybody's trying to figure out when they should buy them, when they should sell them. You know, we help people with YCharts all the time kind of look through their portfolios, understand what they actually have exposure to. I think investors, and we've seen this time and time again, already have far more exposure to these stocks than they think they do. You know, if you look at a 2040 fund, right, somebody that's going to retire, you know, less than 20 years from now, probably 10% of their full allocation is between these stocks, right? So there's just no reason necessarily to go out and have to buy these stocks. You already own them. You're already very heavily invested in the success of these companies just because of how much of the economy they take up.
That's such a great point. I get asked like on CNBC or whatever, or even just like people stop me in an airport or at a steakhouse. Should I buy Google? Dude, you own Google. Believe me. You have a 401k? Yes. Okay. You have a ton of Google in there. I promise you. It is very unlikely that you don't. You have a 529 plan set up for your kids? Yes, both of them. Okay. They have a lot of Google too. Everybody has these stocks by virtue of the fact how many boxes they check in a straight up market cap weighted index fund trying to capture either the United States or even a world stock market index. They are the biggest stocks. And then they appear in dividend ETFs. Apple. They appear in shareholder yield where you factor in buybacks too, right? All of them check that box pretty much. I think with the exception of Amazon. They're in dividend growth ETFs. They're in anything to do with innovation, anything to do with tech, anything to do with whatever, smart beta funds, you'll find them in. So if you own one of them as a standalone position in size alongside of a giant 401k, like you are really exposed. So decide if you want to be. And I think that's a really, really key point that most people don't think twice about.
Moving on to another Animal Spirits co-host, Josh, colleague of yours, Ben Carlson.
Yep.
Ben's got an opinion here about IPOs. We hear over the past 12, 18 months, is it IPO or is it IPO no? What are your thoughts on IPOs and are they a good investment in the future?
So I never like to make a blanket statement by IPOs, right? But if you think about some of the most exciting stocks in the market today, most of them didn't exist in the last 3 years. Like they were not publicly traded companies. We talked about this earlier. A lot of companies have had the benefit of staying private longer. There's been tons of funding for them. They really didn't have anybody pushing them to do an IPO. And then it seems like one of the side effects of the pandemic is that the floodgates opened and everybody raced to get public all at the same time. Unity is the most exciting company on here. If you want my opinion, I don't own it. I owned it pre-IPO. I owned it as a venture-backed startup, and we sold it out of the portfolio once it came public from that strategy. But what Unity has going for it in terms of where the puck is going, just this ability to render realistic virtual environments. And of course, they started as a video game manufacturer, but now it's a platform for everyone. They just bought Peter Jackson's special effects company called Weta Digital, which is based in New Zealand, but that's the digital effects shop that did all of the special effects for the Lord of the Rings series. And so Unity bought that. Why? And by the way, Peter Jackson's retaining a stake as part of that acquisition. Why? Because whatever's going on with video game technology ultimately makes its way to Hollywood and film and TV production. And if this metaverse thing really is going to be one of the biggest breakthrough technologies over the next 10 years and this massive thing that we all start spending more and more hours in the midst of, Unity's platform, like NVIDIA's, which I do own, are going to be very, very important in that mix. So that's a really interesting company. If you don't know it, I suggest doing some research on it, listen to some conference calls and check out their website.
A couple other things that I took a look at with that chart, Sean. One is in the last week or two, these stocks have actually been hit pretty hard, right? So the gains aren't quite as impressive as they look on this chart. But it's interesting just to look at, these are big established companies, right? The only difference between these big established companies and some that have been trading for the last 20 years is that they've been trading a lot longer. But when you get involved in recent IPOs, you're taking on a lot more volatility, and you're not necessarily seeing the outperformance that you should get for that volatility. So I think it's a long-term play, but you got to be able to stomach that volatility. If you look at IPO, the ETF versus SPY, it's about twice, the standard deviation over the last few years.
Yeah, history tells us the biggest winners of all time put their shareholders through hell periodically. That's part of the price that you pay to own a stock that could go up 1,000%. Is that every once in a while you're down 50% from a recent high. And that's if you don't want to sign up for that, right? You don't have to, but that's what it takes. Go ask people who have been in Netflix for the last 20 years. That's part of the game.
All right, so we got 5 charts remaining. We're going to have to go into lightning round. So let's try to get through these in a minute each. First one, Dave's got a point of view here. Dave, who's the director of research at ETF Trends and ETF Database, has a point of view here on the difference between, chasing returns and whether that is or isn't a true statement. Caleb, Josh, what are your thoughts on this chart?
I'll keep it super brief. Dave's a lot smarter than me, but I think that the phenomena of buying the dip is maybe taking over, by the hot stock. So it could be as simple as that.
I chalk this up to Brendan Ahern, who runs Crane Shares, as being a phenomenal salesperson, because I have never, and I love Brendan, I have never seen anything like this. This is, and Dave would acknowledge, there aren't a lot of these situations like this. This is just one extreme outlier where you have an ETF lose this much of its value and see this many people continue to plow money in. So they've got some wholesaling magic going on there. Shout out to Brendan.
It is interesting in the macro. I pulled a little bit of data going in. Of the top 500 ETFs by assets, 110 of them are negative on the year. 85 of those still have positive asset flows.
That's the financial advisor effect, though, because we know that flows to and from ETFs are predominantly driven by people who sit in my chair. And just to give us a little bit of a pat on the back, of all market participants, we are probably the least sensitive to recent performance in terms of where our next dollars are going to.
Yeah.
So I think
systematically disciplined, right?
As an industry, I think we do a good job at building models and then sticking with those models through thick and thin, probably because we work so hard to convince the client to believe in the model. So it's hard for us to give up on them.
All right, we're in the home stretch. We talked about the macro economy. We talked about markets.
Can I just tell you, this pizza is staring at me? So I gotta be honest.
I keep trying to figure out if I could sneak a bite, but
it's beckoning. It's beckoning me. All right, let's go.
Yes, lightning round is not a good time, Caleb. So, Josh, you already talked about this a little bit. The metaverse. What role is the metaverse going to play going forward?
I think I've started to come across adults, grown men, who are sitting with these Oculus helmets on in their homes. I don't want to tell you what they're looking at, but this could be the year where we have a major breakthrough. I had thought Google Glass would have been it, and it wasn't. But there's all kinds of Apple rumors. I don't know if it's a headset or a pair of glasses or a helmet. I hear a different thing every week, but this could be the year that we really get the hardware to match the enthusiasm.
Caleb, any thoughts?
I'm gonna leave it with Josh on this one. He seems much more up to date on the metaverse than me.
All right.
I'm in the pizzaverse right now.
could not get through 2021 or even 2020 chart review without talking.
That's my guy right
crypto.
there.
Yep.
Yeah.
Share your thoughts.
I think $1 trillion comes into crypto, fresh money, in the next 12 to 18 months. And I made that number up out of thin air, but I'm basing it on hundreds, maybe thousands of conversations I've had with wealth management people, hedge fund people, institutions. The dam is broken. And I don't know what that means for price, but a lot of big battleships started to turn this year, including JP Morgan, Bank of America, Fidelity, et cetera. And in my experience, once those battleships start to turn, volatility doesn't stop that. So all of the stuff that the crypto people were saying would happen is happening. But then the last thing on that is be careful what you wish for. So some of the heads of the biggest cryptocurrencies spent the day today talking to Congress, and rules are coming, and maybe the fun part might be over and the serious part is getting started. And I think that will definitely be a big theme for the coming year. We call it Web3 now. It's a whole different thing. We don't say crypto anymore.
You hit my points line by line there, Josh. The only thing I would add is with that big inflow in assets, especially, and Josh, you just said this, right? You know, your firms and people like you are more disciplined. I think we'll see stabilization in the major crypto assets that get those assets from financial advisors. And I think some of these, coins of the day that, my father-in-law is calling me about on the weekend, I think that day trading might subside a little bit.
Well, we still have penny stocks. There's room for both, right? Like a lot of people aren't even aware how much money went into Vanguard over the last 18 months, even though a ton of money also went into Robinhood to trade weekly options. So we could have a parallel track and still have the Doges and the Shiba Inus alongside of a more serious mentality about allocating to these protocols. So, but I think you're right, though. There will be some maturity setting in overall.
In Caleb's, one of his performance goals next year is YCharts is a fundamental research-based tool to find those fundamentals associated with crypto. So Caleb, think about that over the holiday.
The fundamentals are the memes, dude. Good luck.
Yeah. Okay, you guys, who wants to talk about EVs? We always see the charts about Tesla and its market cap is greater than the market cap summation of all other companies in the world. Tesla's not on this chart. Where is the future of EV going as an investment opportunity?
I'm interested in the charging companies. I own one of them. It's not a large cap stock, so I don't want to like talk too much about it here, but I could see myself investing more in EV infrastructure in the first few months of this year. To me, that seems like a better bet than picking one or two of the OEMs.
In the theory of picks and axes is better than gold.
Yeah, I think it's undeniable that by 2030, EV will be standard, and the combustible engine it'll be strange to see somebody buy one. So if you know that that's where we're headed, it's hard to not be bullish on charging infrastructure.
Yeah, I'm a Detroit muscle car guy. Couldn't agree more, though. EV, it's already here. You can't even say it's the future; it's the present, right?
That's right.
Every company's investing all their R&D in EV. Interesting thing here, right? Everybody compares every new EV company to Tesla. Tesla's just so much more than an EV company, right? They're, you see people that say it's a religion more.
Flamethrowers, tequila. I agree.
Right.
Yep. All right, guys, we couldn't end 2021 without mentioning the impact of the retail investor on Wall Street in the form of the meme stocks. And no one but a few people knows who Ramp Capital is. If you're unfamiliar, go look it up. This chart is a little bit
Michael
about
Batnick.
It is Michael Batnick. I hear it's Josh. It might be bad Leroy Brown. We're not sure. AMC and GameStop were the prototypes, but guys, what are your thoughts on the meme stocks and what it means about the retail investors' power in relation to Wall Street?
I think this was probably the most interesting thing that happened the whole year. And interesting, because it crossed over. They were doing skits about this on Saturday Night Live. I did an episode of Desus and Mero for Showtime. There was a movie filmed over the summer about it, which is going to be coming out pretty soon. I have a small part in. I think this was probably the most exciting thing that happened all year. I don't know that there's a really big message about it, other than to say there is a new generation of investors taking the reins from the boomers, and it's not my generation. It's I'm an Xer. It's a whole new group of people, and they buy stocks for all different reasons than we ever thought anyone would, and people are just going to have to get used to that.
The only thing I would add here, Josh, I guarantee for everybody that comes up to you in a bar or a restaurant and asks you if they should buy Google, it was 10x that people asking if they should buy GameStop, right?
Yep.
Those people didn't get rich. If you look at, I think I read that $21 billion of market cap was created in that GameStop run up. 16 billion of that was captured by 9 parties, 2 of which were, I want to say, Fidelity and BlackRock, right? So
hold on, don't eat that. It has sausage in it. My wife's a vegetarian. She came home to what was on the stove.
Just,
I saved you.
There's the cheese. There's a cheese one in the freezer, though. We set you up with one of each, right?
Yeah. Go on. I'm sorry. That was an emergency.
I was just saying that the story, if you follow up on it, it wasn't maybe as beneficial for all the day traders that got in and followed the hype from Reddit. I don't think we saw them all become millionaires. I think as the game played out, the people with the ability to take on more risk, more assets to work with, more capital, we're winning that game.
Remember they were going to put the hedge funds out of business? How did that go? How'd that turn out?
I think every hedge fund out there has an algo now that tracks Reddit. So
yeah, can't believe it.
All right, guys, we're going to move towards a close. We had tons of questions in the Q&A, and I don't think we're going to get through. I'm going to pick 3 that we're going to get through, and apologies to all those that we weren't able to get through. So I guess for each of you, 15 seconds, what do all of these charts in aggregate tell us about investing in 2022?
Buckle up. I don't think the volatility we've seen, the excitement in the markets, I don't think it's going to change. There's just too many stories here that are unfolding for things to settle down too much.
I'm encyclopedic with Wall Street wisdom. I know everybody's quotes. I know who said them, when they said them, but I'm going to leave you with one of my favorites. And this is one where the origin is apocryphal. I'm not 100% sure who actually said it to begin with. But just, on Wall Street, just when you think you have the key to the stock market, they change the locks. So a lot of things that we went into 2021 just assuming changed really radically. And to think that won't happen in 2022, I think would be a really big mistake. I'm going into my 24th year as a stock market participant. And I can tell you that a lot of the stuff that we were saying today and talking about as though it's gospel will not, in fact, turn out to be what we thought even 6 months from now. So you just have to incorporate that mentality into how you carry yourself as an investor, and you'll be okay.
All right, we'll cut it with one more question. It was put in, thoughts on Ray Dalio's comments on China and investing and how that relates to allocations by advisors with their client portfolios. What are your thoughts on China?
You really wanted to end this on a light note. You want to do human rights violations and then we'll score the pizza? Is that what we're doing? I have no comment on Ray Dalio or China or any of that. I haven't thought much about it. I apologize.
Maybe we'll have Perth on sometime and she can give us.
She definitely has opinions. Yep. Yes.
Caleb, anything you want to share before we get back to the main?
Caleb, do you want to trash Dalio real quick, and then we'll see whose pizza was better?
I'm gonna pass on that. I think I'm learning a lot as we go, Josh. And one of the things is when to be quiet, because I know that's not your.
Caleb, I tried to trap you in advance of your performance.
Well, if I'm not saying anything, then you definitely don't need to.
Exactly.
Well, Caleb, you're going to check that box on performance reviews that Caleb appropriately selects topics to talk about. So we've got you there.
Well, the big news is the next slide, right? That's what's going to determine my performance review. So let's see it.
Well, so why we all really came here is let's objectively see who has the best pizza, New York or Chicago. And I honestly haven't seen the results here, so I'm looking forward to Lou Malnati's. Chicago pizza has just slightly edged out New York pizza.
It's about what I would have expected, one or the other by this margin. That's what I would have guessed as I was heating it up.
Very, very tight margin. So thank you guys for objectively settling the score. Josh, we're going to have to go back and edit some of your old podcast commentary now. I'll work with your team.
I'm going to tell you something. Lou Malnati's is a fantastic fantastic Chicago style pizza. I loved it, and I'm going to eat more of it as soon as this ends. So Sean, you were right. It's terrific.
Caleb and Josh, thank you guys a ton. This was incredibly both enjoyable and enlightening. For those of you who joined out, just a reminder of a couple of things. First of all, if you mention Josh's name or either one of these pizza companies when you reach out to YCharts for a new subscription, we will give you a nice healthy 20% discount. So thank you for those of you who joined us who aren't YCharts customers. For those of you who are, reminder of a couple things. All these charts are available in your account, and for everybody, check it on YouTube or an email following, you'll get a copy of this. So that's all I'd say. 2021's not finished. We got some great perspectives on 2022. Thanks a ton, Josh. Thank you a ton, Caleb.
Thank you, guys. This was so much fun. Really appreciate being a part of it.